Today we are diving into a really detailed analysis report. It's titled The Next AI Superstock. Marvell's data center revenue jumps 37%.
Right.
It does a great job weaving together Marvell's Q3 earnings, that huge 38% jump in data center revenue, and also the whole strategic angle with the Celestial AI deal. It's got the hard data.
It really does. The material is incredibly strong, and you've absolutely established that baseline with the numbers. But I think to really make this report stand out from, every other earnings recap out there, we need to tweak how we frame that strength right from the top.
You want it to land as a definitive infrastructure thesis.
Not just a strong quarterly report.
Exactly. We need to show the growth is structural, not just cyclical.
That's where the real value is, precisely. Which brings us to our first point of critique. The initial framing of the analysis should pivot immediately from general Q3 revenue growth to Marvell's unique, forward-looking strategic position in the AI supply chain.
Okay, so right now the analysis opens with that big 37% total revenue jump. It's meant to grab your attention.
And it does.
But the weakness is that, it's a backward-looking number. And by leading with it, it almost diminishes the importance of the actual reason for that growth. It makes the piece feel like a standard earnings recap.
When it's so much more than that, it's a deep infrastructure analysis. The growth is just the consequence of the strategy, right?
Right.
We have to flip the order in the story. So the suggestion is to immediately bring in the custom silicon, the ASIC dominance, and the fact that the data center business is now 73% of their total business?
A huge number.
A massive number. You lead with that, and you immediately show why this growth is different, why it's structurally solid and not just a one-time thing.
You're defining the infrastructure play from the first sentence.
Yes. You're defining their shift into being an AI connectivity specialist before you even get to the numbers that prove it. I mean, think about it. Investors, analysts, they are so tired of just hearing about generic revenue jumps in AI.
They need to see the structural differentiation.
Immediately. And that 73% figure, that's what provides it.
I hear you on asserting the structural change first. But is there a risk of burying the lead a bit? I mean, that 37% jump is still the big, exciting headline.
It is, but we're not getting rid of it. We're just using it as supporting evidence, not as the thesis itself. So for a concrete example, instead of a bullet point that says total revenue is up 37%, you start with an assertion.
Something like, Marvell has fundamentally transitioned into an AI infrastructure company.
Yes. And then you say, confirmed by the fact that data center revenue now makes up 73% of the business. Then you use that 38% jump as the undeniable proof.
As evidence of the demand for their custom AI silicon from, Amazon, Google, the big hyperscalers.
Exactly. See how that changes things? It immediately focuses the reader on the future-proof part of the business, the high-margin design wins, and it makes the whole argument feel more robust from the very first sentence.
Instead of making them wait for Section 2 to figure out what's really driving the stock.
You've instantly elevated the whole report.
That makes perfect sense. Okay, so if we've set up the strategy and the success, let's talk about the future catalyst. This brings us to the second critique. The narrative needs to fully integrate the Celestial AI acquisition as an essential catalyst, not just some standalone add-on.
Right. As the analysis is written now, it treats Celestial AI like this secret weapon that gets revealed in Section 3.
It's kind of siloed off?
It is. And the weakness there is that it completely disconnects it from the main story about the data center growth and custom silicon. You end up with two separate narratives. You have the ASIC success story over here and the future optical story over there.
And by separating them, you miss the chance to use the acquisition as the technical proof that Marvell is already solving the next big problem. The photonic fabric tech is a huge deal. It needs to be tied directly to what's happening in data centers right now.
It's all about logical necessity. That's the key. So the suggestion here is to resequence it. You've just established this massive data center dominance, right? This incredible demand for custom silicon.
Okay.
Well, what's the problem that dominance creates? It's that copper wires get too hot and too slow when you try to scale these AI clusters to, tens of thousands of GPUs.
I see where you're going. You create this problem-solution narrative.
Exactly. It makes the Celestial acquisition feel like a necessary, preemptive move by a leader, not just some random deal they did. It strengthens the whole argument that Marvell was going to own optical interconnects.
Which is where the next wave of growth is. It reminds me of older networking standards, like the move to InfiniBand. Marvell is trying to build that essential connectivity layer before the rest of the industry even knows how badly they need it.
They see the writing on the wall.
So just for a moment to ground the concept,
When we talk about this photonic fabric, what does it actually do that copper can't? In just a sentence or two.
Sure, it just means data travels over light instead of electricity. So when you're connecting all those GPUs, copper cables start to lose signal, they use a ton of power, and they generate a lot of heat.
Okay.
Celestial's tech replaces all that bulky, slow copper with what is essentially a light-speed fiber network inside the data center. It's the only way you can really scale up to the massive AI models of the future. It's basically the nervous system for an AI supercomputer.
That framework is perfect. It turns the Celestial deal from a footnote into the absolute lifeline for their whole data center strategy. It's a much more powerful story.
Absolutely. So for a concrete example, after you talk about the booming custom silicon demand, you pivot immediately to the physical constraints these giant clusters are facing.
Use that technical bottleneck as the setup.
Use it as the preamble for introducing Celestial AI solution. Show that Marvell is investing proactively to build that future nervous system.
And then, only after you've established why it's so strategically vital, then you drop the financial target, the $500 million annualized revenue run rate by FY 2028.
Exactly. The sequencing makes that number feel earned and inevitable, not just like some arbitrary projection. It creates a much tighter narrative arc.
That structural change really does strengthen the whole thesis. Okay, let's pivot to the back half of the analysis report. Let's talk about risk. Critique number 3. The valuation analysis needs to go beyond general market talk and link the high PE ratio directly to specific operational execution milestones.
This is a big one. The report does a fantastic job building the bull case. It compares Marvell to Broadcom. It highlights all the analyst upgrades, Raymond James at 121.
Right.
But then it gets to the risk section, and the weaknesses, it's just too generic.
It says the stock is volatile and needs to keep beating earnings perfectly. I mean, you could say that about almost any high-growth tech stock.
Right. It completely fails to use the specific data points that the report already laid out. The 30x forward PE, that Celestial target, the reliance on a few huge ASIC customers. That generic risk assessment, it dilutes the depth of the analysis you've spent the whole time building.
It feels like a template was just dropped in at the end.
It really does.
I agree the risk needs to be more specific, but if we tie the 30 times PE only to the Celestial target and the ASIC pipeline, do we risk making it too narrow? I mean, isn't some context on general market risk helpful?
Just for balance?
That's a fair point. But when a stock is trading at 30 times forward earnings, the market isn't pricing in general sector growth anymore. It's pricing in flawless execution on very specific projects.
Okay.
So our suggestion is to directly connect the justification for that high valuation, that 30 times PE, to the success metrics of the key growth drivers you've already identified.
So we treat the high valuation not as some weird market thing, but as a direct measure of what the company absolutely has to deliver.
Exactly. It creates a much stronger, more specific risk analysis that is unique to Marvell's strategy right now. It forces the reader to see that the high price isn't just sentiment. It's based on them pulling off these two very specific, high-stakes projects.
So for concrete examples, we would acknowledge the analyst optimism, but then immediately say that the justification for that 30x forward PE hangs on two critical points.
Point 1. Marvell has to hit that ambitious $500 million revenue run rate for Celestial AI by fiscal year 28. And that's not a given. That implies a really steep ramp, perfect integration. There's real technical and sales risk there.
And point 2 would be they have to maintain flawless execution in that high-margin custom AI silicon pipeline. And we need to be clear about what flawless means.
What does it mean?
It means hitting their roadmap deadlines, meeting volume commitments, and frankly, keeping those hyperscalers from deciding to just build their next chips entirely in-house.
And failure in either of those two specific areas, missing the Celestial ramp or a delay with a big custom silicon client, that represents the real, non-generic risk to the stock. By framing it that way, you show the reader exactly what to watch for. You tie the financials directly to the operational reality.
That's a much sharper, more actionable conclusion to the analysis report. It shows a real understanding of the high-stakes game Marvell is playing right now. It goes way beyond just looking at financial ratios.
And maximizing the impact of this report means making sure every single piece, from the opening to the conclusion, reinforces that central argument, that Marvell really has graduated to a legitimate next-gen AI growth stock.
Worthy of the premium valuation.
If, and only if, they hit these very specific milestones.
This has been